Hello everyone. I would like to continue the discussion of the combination topic. If you remember in the first chapter in the textbook, we talked about the theoretical part of combinations. We explained the different types, the reasons for that, and the benefits from combinations. And in the second chapter, we talked about the ownership of the parent company in the subsidiary company. Whether the company owns less than 20%, and this way we call it using the cost method, or between 20 to 50%, and here we use the equity method. And we had all the journals of these two methods during the second chapter. But today we'll start the third chapter where we talk about ownership of more than 50%. Here we start talking about the journal entries, and then the worksheet we do it, and we end up by consolidated financial statements. So just to recap what we have done it, if you remember this slide from the second chapter, that we have the first ownership less than 20%, we use the cost method. 20 to 50% we use equity method. More than 50% we use consolidated financial statements. So what am I going to discuss in this chapter? As you can see, 4 key points. The first, we will go through the journal entries again. Then we go through the acquisition expenses and how we record them. But the key portion in this chapter is how to build the consolidated balance sheet of the parent and the subsidiary together, including the elimination entries and the worksheet. We do it before we make the final balance sheet. So let us go through these 4 points briefly, explaining them by different examples and numbers so you understand what we mean by each one. First is the stock purchase entry. When a parent company is buying shares of subsidiary company, we debit investment in subsidiary company, and here we take the number of shares, multiply them by the fair value, and then we credit cash, common stock by the shares times par value, and then credit other contributed capital, which is the difference between the fair value of the share and the par value. Then, if the parent company is paying any expenses like consultation, then we debit acquisition expense. This is including all the expenses we pay to the different parties. But for the registration of the new shares, we debit other contributed capital or additional paid-in capital. And then we credit cash. If there is any payable for the acquisition expense, we credit acquisition cost payable. And then if something to be paid in the future, we credit deferred acquisition charges. So here this is mainly for all the related expenses of the acquisition. And then we start working on the balance sheet. How do we make the balance sheet? First, we make the assets, where as you can see them, we almost add all the numbers of the subsidiary balance sheet with the parent balance sheet. So for example, cash, where we add the 2 cash amounts of parent and subsidiary minus any payment the parent has paid for acquiring the subsidiary company. Accounts receivable, inventory, plant and equipment, land, for all of them we add the amounts which will be given in the example of the parent company plus the subsidiary company. And as you know from the previous 2 chapters, if the company pays more than the net asset, we create goodwill, which will be debit, and here you can see it is going to be the difference. For the liabilities, more or less we do the same as the assets, where we add all the amounts in the parent company balance sheet with all the amounts in subsidiary balance sheet. So whether accounts payable, mortgage payable, bonds payable, any long-term liabilities, we add the 2 amounts. But when we come to the equity section, here is the difference. If the company doesn't buy 100% of the subsidiary, but they bought more than 50%, we create a new account, we call it non-controlling interest, which will be the minor shareholders in the subsidiary company. And they have to show up in the consolidated balance sheet that we make it. So the non-controlling interest is the remaining minor shareholders in the subsidiary after the acquisition. Where you can see here, I put the subsidiary plus any gain or loss that happens to the non-controlling interest. And by the way, in the coming journal entries, you will see non-controlling interest is initialized by NCI. For common stock, other contributed capital or additional paid-in capital, retained earnings, we put only the amounts for parent company. So here we remove the amounts of a common stock, other contributed capital, and retained earnings of the subsidiary because the subsidiary shares don't exist anymore. And now let us go for the elimination entries, where we debit common stock of the subsidiary shares times their par value, other contributed capital or additional paid-in capital, subsidiary shares times the difference between fair value and par value, retained earnings of subsidiary company, and then if we get goodwill, we put it in the debit side. We credit investment in subsidiary company, where we put the number of shares of the subsidiary multiplied by their fair value. NCI, which is the non-controlling interest, we put their equity portion plus their profit portion. And then if we get gain on purchase, as I said earlier, if the cash we paid less than the net identifiable asset, then we create gain on purchase. And then we make different 4 steps to see whether we will get the gain or goodwill. So first of all, we see the percentage of the stock acquired by the parent company, either 100% or less than 100. Then we get something, we call it implied value, by dividing the purchase price that has been paid by the parent divided by the percentage acquired. The percentage acquired, we get it from step 1, which will be given in the exam. In the third step, we get the book value of the subsidiary, which will be given in their balance sheet, which is common stock plus other contributed capital or additional paid-in capital plus the retained earnings. Remember, all these amounts only for the subsidiary. And then we subtract step 2 minus step 3 to get either goodwill or bargain purchase. And here we might have 3 cases. I will take each case and explain the 2 conditions of that case and show you a brief example. Case 1, where the implied value equal to the book value. It means no goodwill, no gain. Case 2, the implied value is higher than the book value, and here we get goodwill. Case 3, the implied value less than the book value, and here we get gain on purchase. So let us look at each case and the conditions that might happen under each case. In case 1, we said the implied value might be equal to the book value, and the parent might acquire 100% of the subsidiary, which means there is no NCI, or the parent might acquire less than 100, and here we have NCI by the difference. Let us take a simple illustration. I assume on January 1st, 2013, the parent company acquired all, which means 100% of the outstanding stock, 10,000 shares of subsidiary company for 160,000 cash. What journal would P company make to record the shares of S company? So here you can see we have 10,000 shares for 160,000 cash. We debit investment in S company by 160 and credit cash 160. This is a very simple example, and now let us see. The balance sheet of both companies immediately after the acquisition, as you can see it here, the parent company with a subsidiary company. And now we need to see the difference here between the implied and the book value. First, the parent acquired 100%. The implied value, which is the purchase price 160 divided by 100%, we get 160. And the book value of the subsidiary is 160. From where I get it? Here, if you look at the last three amounts, common stock, other contributed capital, and retained earnings of the subsidiary, if you add them together, you get 160. So here is the third step, 160. The difference between step 2 and 3 is 0. And now we need to do the work entry. So we debit common stock of the subsidiary by 100,000, other contributed capital by 20, retained earnings 40, and all of them you can see between brackets, they means S, which means for the subsidiary company. We credit the investment in subsidiary company 160, and here there is no goodwill and no gain. And now let us look at the elimination entry with the consolidated balance sheet. As you remember, we said for the assets here, we add up the subsidiary plus the parent. For the liabilities, we do the same, but for the equity side, we put only the parent company. So for cash, we add up the two amounts, we get 80,000. Other current assets, 380,000. Plant and equipment, 320,000. Land, 120,000. But now we need to close the investment in subsidiary company. It's debit in the parent. We put it credit in the closing entry. So in the consolidated balances, it will be 0. And here we get the total. In the liability side, it will be 220,000. For the common stock, I start to cancel the common stock of subsidiary company, which is 100. And the remaining common stock of the parent will remain in the consolidated balance sheet, 400. The same thing for other contributed capital and retained earnings. The amounts for the subsidiary will disappear, and the ones for the parent company will remain. And here we can see the final amount. So this one, we call it work paper or worksheet, where we show up the elimination journal to cancel the investment and the subsidiary equity side. Now, how about if the ownership is less than 100%? And in this case, we will see non-controlling interest remaining in the consolidated balance sheet. So we assume on the same date the parent company acquired not 100, 90%. 9,000 shares for 144,000 cash. What is the journal entry? We debit investment in subsidiary company, credit cash by the amount, which is in this scenario the same accounts with different amounts. Now, we need to see the differences, whether we have goodwill or gain. We get the percentage acquired 90%, then the implied amount will be 160, the book value 160. So even if the company owns less than 100, still there is no goodwill or no gain on purchase. And here you can see that we created a new section for the non-controlling shares of 10%. And if I add the parent amount with the non-controlling, I will get the same total amount of the subsidiary equity side. And now let us look at the work paper for the cash, other contributed capital, plant and equipment, land. We add the parent with the subsidiary. For the investment, we put it credit. For the liabilities, we add them together. But for the common stock, other contributed capital, and retained earnings, we cancel the amounts for the subsidiary. And now we create a new account which didn't exist in the previous work paper, non-controlling interest by 16,000 credit. And then we can see here the elimination and the consolidated amount. In the second case, we will talk about the implied value more than the book value with the same two conditions that we assumed them in the previous case. In the first condition, if the parent company acquires 100% of the subsidiary, and in the second condition, if the parent acquires less than 100. And what I'm going to do in case 2 and case 3, that I will focus on B condition rather than A condition for one reason. If you get B, it will be easy for you to understand A, so I don't like to be redundant. So I focused only on B when I go for case 2 now and case 3. So let us look at the same scenario we assumed in case 1. We assume that on January 1, the parent company acquired 80% shares for 148. If you remember, in the previous case, what they bought was exactly equal to the book value, so we didn't have an issue. But here we have an issue because they paid more than what they should pay. The journal entry, we debit investment in subsidiary company and we credit cash by the same amount. And here we start to calculate the 4 steps. We have it before. First, we see the percentage. As you know, it was 80%. The implied value, we divide what the company paid, 148,000 divided by 80,000, we get 185,000. Minus book value, which is 160, as we know it from case 1. So the difference here will be 25,000, which is the goodwill. In the example, and you might see it in the textbook, we might say where this amount should go under goodwill, or they might say that the difference will be allocated to one of the assets like plant and equipment or land, which means the difference will increase the asset side rather than creating a new account called goodwill. So in this example, we assume that the 25,000 will be allocated to the revaluation of the land. Now, if the company paid 80%, then there is NCI of 20%, and you can see here that the difference of the amount paid and the other one for 25,000 has been allocated to the land, where 20,000 out of the 25 will go to the parent and the 5,000 will go to the NCI. And then we make the elimination entry. We debit common stock, other contributed capital, retained earnings, and credit investment in subsidiary and NCI, and the difference will go into difference between implied value and book value. This difference will be closed in the land, so we debit land and credit the difference. And here you can see the worksheet where we see the addition of all the assets, liabilities, as we did it in previous case. But here you can see in the elimination, there is a new account difference between implied value and book value has been debited and credited at the same time, and the difference goes to the land, 25,000. In case 3, we assume the implied value is lower than the book value with 2 conditions. The first, the company acquires 100%. The second one, the company acquires less than 100%. And I'm going to focus on B condition, and we do the same thing. And I think now you can get it by yourself. If the implied value is lower than book value, we get gain on purchase. So if we look at the same example here, the company acquired 80% for 120. We debit investment in subsidiary company and credit cash by 120. And here we make the 4 steps. First, the acquired percentage, 80%. The price paid, 120,000 divided by 80%, we get 150. Minus book value, 160, we get 10,000 difference as gain. And here we assume the difference is attributable to plant and equipment In this case, there is overvaluation of 10,000 that will be split between 8,000 to the parent and 2,000 to the NCI. And here we make the closing entries or the elimination entry. We debit common stock, other contributed capital, retained earnings, and credit investment in subsidiary company, non-controlling interest, and the difference will go to the credit side. Either we call it gain on purchase or difference between implied value and book value, which will be closed in plant and equipment. And as you can see here in the worksheet, that all the accounts were similar to case 2, except in case 3, we see the difference goes to the credit side and reducing the asset amount. So this is in brief the different scenarios that we do it when we make consolidation among the financial statements of the subsidiary and the parent company with 3 cases: either the implied equal to the book value, or the implied value is higher than the book value where we got goodwill, or implied lower than the good value where we get gain on purchase. And I hope you find these simple examples useful to understand the topic of chapter 3. Please make sure to go through the exercises of the textbook with the model answer that I uploaded on the Moodle. And if you have any question, let me know. This chapter actually is the cornerstone of the whole course to show you how to start making the consolidation among the parent and the subsidiary company. I hope you enjoy the discussion, and I hope you find this information useful, and I'll come back to you soon. Thank you, and wish you a successful week. Thank you. Bye-bye.